Hey, everybody. Welcome to Money Monday. Because on Monday we talk about money, and I was not creative enough to come up with something else. If you don't know me, my name is Kyle Thompson, and this is Jasper. Say hey, buddy. uh, I am a financial planner, and I run a wealth management and business advisory firm called Lead Town Advisors. Um, and this is the first webinar that I'm doing, purely educational. There's no pitch that comes along with this. Today is in office hours. We're mostly going to cover retirement plans, what to do with them, how much to save, yada, yada, yada. And if you have questions, feel free to put them in the chat or the Q&A or however the fuck this works. I don't really know. Yeah, I'm going to figure this out as I go along. So here we go. So the first question here is, I have 5 questions today. I'm going to try to keep this under 20 minutes. The first question is the biggest question, and so that's what we're going to cover first. The first question is, how should I set up my workplace retirement plan? Now, let's assume you have a workplace retirement plan. So it depends on what kind of plan you have. For the sake of our purposes today, we're going to assume you have the most common type of plan, which is a 401k with both a traditional and a Roth option and a 3% match. However, there's lots of other different kinds of retirement plans and compensation available. So similar to 401ks, there are also SEP IRAs and simple IRAs. Those have different rules and contribution limits. On the nonprofit side, there's also 403bs, 457s, both public and private. There's 401as. In the stock compensation realm, there's also employee stock ownership plans, employee stock participation plans, which are different and also have very different tax implications. There's restricted stock units, stock options. There's all different kinds of non-qualified plans, such as phantom stock and stock appreciation rights. And there's a whole bunch of different types of pension plans. Pension plans are getting more rare, but they are still out there, especially in the government space. But for the sake of what we're doing today, we're just going to focus on 401ks because everything else would take too long. I could do an entire episode just on those, and probably will at some point. If you do want me to do that, let me know. Send me an email, KyleT@Lead Advisors, and tell me what you want me to cover. You can even give me some details about your situation, and I will cover that. And speaking of your situation, everything I'm covering today is just general rule of thumb. This is not advice specific to your situation because I don't know it. So these are rules of thumb, not necessarily what you should do. You should probably hire an advisor, wink, wink, to help you with that. So let's assume you have a 401k with a 3% match, and you have both traditional and Roth options, which we'll get to the traditional. The next question will be, should I do traditional and Roth, and what the fuck are they? So that'll be next. But first off, how much should I be contributing? That's usually one of the big questions, along with the other question of traditional Roth. How much should I be saving? Well, if you have a match, you should always be saving enough to max out the match. The most common type of match is a 100% match up to 3%, but sometimes they can get funky with it, and they'll do a 50% match up to 6%, which means they are not matching 6%. They're matching half of that, which is 3%. Then there's all sorts of other things that they can do. Like they can do 100% match up to 3% and half a match up to whatever. They can do a flat match. They can do profit sharing contributions. There's a whole bunch of things that they can do. But if you have a match, you should at least be saving enough to get that. Now, how much should you be saving in general? That depends on when you want to become financially independent, because I really hate the term retirement. To me, retirement is just waiting to die. Financial independence means You can keep working or not. Work becomes optional. You can, at any given time, once you become financially independent, you can give your boss the finger and walk out of the office. Cool. I don't blame you. But how much should you be saving? Well, if you want to become financially independent at age 70, which no one wants to, that's super late, you really only need to save 3 to 5% of your income. That's not very much. If you want to become independent at 65, then the number becomes like 10 to 15%. And if you want to retire, or if you want to become independent at 60, that number is 20 to 25%, depending on your current age. So if you're 25 years old right now, you do not need to save 25% of your income. But if you're 45, yeah, you're going to have to be more aggressive. Generally speaking, I try to get clients to save about 20% of their income and no more, unless there are specific goals attached to additional savings. Because the reality is, even though we say we want to be independent at 60, a lot of us, especially the millennial generation and Gen X and Gen Z, we're not actually going to do it. Like, honestly, I think if I were to quote unquote retire at 60, I would just get bored, and a year or 2 or 3 later, I would just start doing something else. Like I would go back to work. I would have to do something because I'd be bored. And I think that's just how we are wired. And so I do encourage a 20% savings rate, but I don't actually expect that to be a net 20 savings. I do expect that you will spend some of that at some point. You may want to spend it on renovations on your house. It may be a big vacation. And my big thing, the thing that I'm really in favor of, is sabbaticals. So you want to not work for 3, 6, 12 months in your 40s, so that you can, travel or spend time with your kids or do whatever. I fully encourage that. I think that is better than trying to retire early. I just like that a whole lot more. I'll probably do at some point an entire episode on sabbaticals, but we'll leave that for then. But yeah, I try to get people to shoot for a 20% savings rate. There are some clients that I have that are just habitual savers, and I have to actually get them down to 20%. And because if you're saving more than 20%, you're probably losing out on experiences that you could be doing now. So if they're saving more than 20, that's fine. But anything above that, I try to force them to have a something that they want to spend that money on, whether that's vacation, home renovation, rental property, paying off their student loans, whatever it is. We got to have some sort of goal for those savings, and not just putting it away for the sake of putting it away. The entire purpose of money is to either spend it or give it away, because once you're dead, you can't use it. So at some point, it's either you got to either spend it or it's going to go to someone else. Period. That's the long and the short of it. So you just got to figure out what the hell you want to do with it. And I do have a specific exercise around that. Maybe I'll do something on that eventually too. So yeah, 20% of your income. Now, should all of that go to your workplace retirement plan? Absolutely not. Because of the loss of flexibility with workplace plans, flexibility and liquidity, you don't really have access to that money unless you take a loan against it, which there's complications about, blah, blah, blah. But there's reasons to do it sometimes. But generally speaking, you don't want to do that. So what I encourage people to do is whatever their savings rate is, if you can be at 20% savings rate, half of that should be going to your workplace plan. Half of it should be going to non-qualified savings, such as a brokerage account, or some other things. It just kind of depends, which I'm going to cover brokerage accounts here in a little bit. But yeah, so save at least the match in your 401k, and have half of your savings, whatever that savings rate is. If it's 10%, put 5 in your 401k and 5 outside of it. But ideally 10 and 10. But if you're high income, the contribution limit on a 401k right now is $19,500. So if you make more than $200,000, you won't be able to put 10% in. So you have to do something else with it. And there's options for that. And again, depends on your situation. And as far as like the actual investments that you hold in your 401k, the standard one that's usually chosen for you, the default one, is what's called a target date fund. So they take your age and your assumed age of retirement and put you in a fund that is supposedly good for you at that age to retire on. The problem is when you're young, they start out very aggressive. They're more stocks than bonds. And then as you get older, it starts to go, it's going to seem better from your perspective from here. Okay, so it starts out aggressive, then it moves down and down and down and down, gets more conservative as your age goes up. And honestly, by the time you're 35, 40 years old, a lot of times it's just too conservative. So if you're under 35 or 40, a target date fund is totally fine. You don't have to do anything more complicated than that. However, once you get to 35 or so, you should be looking at doing some sort of custom allocation, because it's honestly too conservative. Really, you don't need to start getting conservative with your money until about 5 or 10 years out from retirement. There's this thing called the retirement red zone, where sequence of returns starts to matter, which you can Google sequence of returns in retirement, and it'll come up with a whole bunch of stuff that's really fun to read for me. Probably boring as shit to you, but that's why you're watching this. So you really don't need to be conservative until about 5-10 years out. It's that red zone around retirement where it's really, things get more complicated. Yeah, once you get to 35, 40 years old, you really need to start looking at a more custom allocation and be a little more specific with what you want. I see we got a question in the Q&A, which I will answer when I get to question number 3. So I will get to that here in a minute. So let's move on. So that covers workplace retirement plans. For like, if you are an employee, if you are an employer, I will cover that in question 3. So let's move on to question number 2, which is, should I be doing traditional or Roth contributions? And that depends entirely on your tax bracket, now what you are in as a household, not just as an individual. So sometimes, one spouse is lower income and one spouse is much higher income, and that makes things more complicated, because if you're making 50,000 and your spouse is making 250, that complicates things. That puts you at a total income of 300,000, which means you are in a higher tax bracket versus a lower. And so this advice changes. So again, you need to figure out what your particular situation entails. But generally speaking, so there's 4 tax brackets for which you should probably, almost definitely, or probably be doing Roth contributions. So if your tax bracket is 10%, 12%, 22, or 24, you should almost definitely be doing Roth contributions. 24% is where it could go either way. Just it depends. There, you have to do a tax projection, and there's some situations in where it's better to do pre-tax versus Roth. And that depends on your own personal situation, especially if you have, like, I have one client that has they have a shitload of kids, and so they get a whole bunch of deductions from that, tax credits. So it's actually better for them to do Roth versus traditional. because they're actually not deferring that much taxes. And the reason, especially now, you want to be doing Roth, at least for the next 5 years, 4 years, is because in 2026, we change back to the same tax brackets we had under Obama. So all of those brackets are going up, back up a few percent. So stuff them away Roth now. So you'd rather pay 24% now than 28% later. Or potentially when you get to retirement, you have what's called required minimum distributions, which can end up with a giant tax bomb, and you end up paying more in taxes then than if you would have just paid them now. So again, it depends on your situation. If you're above the 24% tax bracket, meaning you're in the 32, 35, 37, which starts at 170,000 in income for individuals and 340,000 for married couples. If you're above that, absolutely pre-tax, no questions. You should do that 100%, unless there's some tax proposals to change things for how retirement deductions work. I don't think those are going to go through, honestly, but if they do, then yes, that's going to affect you and it's going to change those things. But as of right now, stick with the pre-tax. All right. Now, the third question here is, what should I do if I'm self-employed or not covered by a plan at work? Which that is the question I got in the chat. Or if there's less than 5 employees or 5 to 50. So those are kind of different questions, but pretty similar answers, honestly. So let's say you are self-employed and it's just you, and you make less than $100,000 a year, and your spouse is of a similar income, or you don't have a spouse. In that case, honestly, really all you need is a Roth IRA and a brokerage account, which a brokerage account I will cover in the next question. But for now, probably just a Roth IRA and a brokerage. Once you start getting above 100, and then definitely at 150,000, or if your spouse is very high income and you can defer a lot of your income, then a solo 401k makes a lot of sense. The reason I say it doesn't make sense below 100,000 is because there's sometimes it costs anywhere from $500 to $2,000 to set up a full solo 401k, and if you're not going to be contributing near the max amount to it, it's just not worth doing. But once you get to 100, and especially at 150,000, then it can really be worth it. And then once you get to 250 or above, and especially if you're getting close to your retirement age or independence age, then a cash balance plan can be put in place, because the contribution limits to a cash balance plan are like 4 or 5 times that would of a 401k. Now that's if you're self-employed, no employees. If you do have employees, in the past, it used to be really, really common. It's still fairly common to use either a SEP, which is short for Simplified Employee Pension, which it's actually not a pension, so I don't know why the hell it's called that, but a SEP IRA, or a simple IRA, which those have different contribution limits. The contribution limit for a SEP IRA is 25% of your adjusted gross income, up to 57,500 a year, which is fine if you're purely a pass-through entity. But if you are an S corp, then that makes things more complicated and it probably doesn't make sense. And then a simple IRA is very easy to administer, but it comes with a bunch of weird rules that I don't really like. It's cheap to set up and administer, but chances are if you're going to do a simple IRA, you're probably on track to need to do a 401k anyways, and it's going to save you a lot of headache by just going straight to the 401k. Yes, it's probably going to cost you $1,000 or $2,000 to set up, but once it's done, it's so much easier to administer, and you don't have to dick with it later on. Just if you have employees, just go straight to a 401k. it's just going to be so much easier for you to take on. There's different kinds of 401ks. So there's the regular 401, there's different kinds of regular 401ks, and there's also safe harbor. Safe harbor allows you to be more flexible on your match or your profit sharing plan. Um, but it means your vesting schedule for employees is different. There's different rules for vesting schedules. So you may want to be, so let's say you are very generous with your employee match and you want to match them up to 10%, but you're afraid that by being generous, they may end up leaving, or if you're afraid they might leave too early and all that extra money you paid them through the match is gone. Well, you can have a vesting schedule so that it takes 6 years to vest. Now that you can do that under a regular 401k plan, but under a safe harbor plan where there's no top heavy testing, meaning the owners aren't using it as a vehicle to defer more money than their employees are, then it has to vest immediately. And again, if you're a business owner or like the person that asked this question and is a CPA that works with business owners, there's a lot of complexity here. And so it depends on the individual situation. So if you want to talk about that, let me know. And or submit some questions that I'll answer some other time. And we can go into what kinds of retirement plans work best for specific kinds of businesses, because that's kind of beyond the scope of this. And holy shit, I'm already at 20 minutes. All right, so let's move on from that. Yeah, so again, just to recap, if you're lower income, under 100,000, Roth IRA and a brokerage account. If you're over 100, 150, then a solo 401k works, or if you have employees, then a 401k. If you're over 250, and especially once you get to like 500,000 in income, a cash balance plan is probably going to be a good option. All right, so question number 4 is, what is a brokerage account and why should I be saving there as well? Okay, so brokerage account, very simple. There's 3 kinds of tax qualifications of 3 different kinds of tax qualified accounts. So there are pre-tax, like a regular 401k, there's post-tax, like a Roth, and then there's taxable accounts like a brokerage or other different kinds of deferred comp. A brokerage account is basically just a savings account that you can hold investments in. That's it. So the big advantages to that is there's no contribution limit like there are in 401ks, IRAs, pensions. There's no contribution limit. You can put as much money in as you want at any time. There's no penalties for taking money out. Like with 401ks and IRAs, if you're under age 59 and a half, you pay a 10% penalty on any money you take out. And which that really sucks, especially for lower income people, because those are the ones most likely to take money out of their qualified accounts. It just hits them extra hard, and it's not fair. That's why people should be saving in a brokerage account. Third, they're taxed at capital gains rates, which are, depending on your income, either 0%, 15%, or 20%. And if you have a financial planner that is really good with tax planning, they can get you to financial independence and then harvest those capital gains at a 0% rate. I do that for people all the time, and it is fun to show them how much money in taxes they can save. So yes, you should absolutely be doing a brokerage account. And again, that should be roughly half of your savings. The other half should be going into retirement accounts of some sort. Finally, the thing that you can use a brokerage account that you can't use a qualified account for is I use mine personally. Basically all my money goes into it and I pay all my bills out of it. I use it as a cash management account. You can also use it as a line of credit. So you can borrow against it. It's at a higher rate than a mortgage, but a lower rate than a credit card. You can set up a debit card to go with it. So I use it as a cash management account, and basically all of my extra money goes into there every month, and that way, so I know I can see what's coming in, going out, and that money stays invested and continues to grow. Last question here is, how much do I really need as an emergency fund? And the answer to that depends on how the two things it depends on is how volatile your earnings are. So if you are a government employee that makes the same amount every month, week in, week out, you don't need much. But if you are in a sales role, such as like a realtor where your job is very seasonal, then you probably need more. The second factor that you need to consider is what your insurance deductibles are. So if you have a PPO health plan with low deductibles, if you have comprehensive car insurance with low deductibles, et cetera, then you don't need much. You need at least 1 month worth of expenses plus whatever your deductibles are. So if 1 month of income for your household is $10,000, or 1 month of expenses is $10,000, and you have another $5,000 in deductibles between your health plan and your car insurance, then 15 grand is all you need as an emergency fund kept in your savings. Everything else should be invested, because otherwise you're just losing money to inflation. If you're a realtor though, you probably need somewhere between 3 to 6 months plus that deductible. So that's what matters. All right, I got 3 minutes left before we're at a half hour. This went way longer than I thought it would. Thanks everybody for coming. I really, really appreciate it. If you have any questions, please send them my way. Again, Kyle T at Leetown Advisors. And next week's episode is going to be all about student loans, which, as we know, are fun but complicated. And I feel like we do not have good enough education on that. So that's what next week is going to be. Yeah, please submit any questions that you have, and we will go from there. All right. Thanks a lot, guys. Have a good one. You're welcome, Drake. See ya.